Of David, Claire and myself, thank you all for dialing in to our webinar. Our aim over the next hour is to look at some of the key employment tax and other practical issues that need to be considered, along with the pitfalls to avoid when exiting an employee from a company. We will not, however, be dealing with any legal issues that may arise. Over the next hour, we will cover how any cash payments are taxed, the tax treatment of share-based awards, the position regarding cash-based plans and the exercise of discretion, the tax and practical implications of implementing clawback or malus adjustment, and the situation where any loss of office payments are governed by a company's remuneration policy. Following the webinar, we will send you a copy of the slides together with information on the new online share plan filing requirements, which must be completed by the 6th of July 2015. And the new tax rules for internationally mobile employees participating in equity plans, which are two current hot topics. If you have any questions in respect of either of these two hot topics, or of course any issues that we discussed today, please do not hesitate to contact us. I will hand over to Claire now, who will be explaining how cash-based payments made on termination should be taxed in the UK.
Thank you, Matthew, and good afternoon, everybody. Over the years, I have advised and commented on a wide range of termination employment situations and the associated payments and benefits provided to departing and former employees. The legislation and relevant case law has remained fairly settled over the last few years, but despite this, it is still an area where many employers make errors because the rules are complex. This afternoon, I'm looking at the key income tax, NIC and related reporting considerations in respect of termination packages, and perhaps dispelling a few myths. I will not be looking at the legal implications of making termination payments, but when employees' contracts are being terminated, separate legal advice should be sought in addition to income tax and NIC advice. I've tried to make this session as practical as possible, as I know that we have a broad range of professionals listening today. But by necessity, I will be referring to legislation and pieces of significant case law from time to time, for which I apologise in advance. Most people are aware of the £30,000 exemption, which may be available to reduce the income tax payable on termination payments. And perhaps there's a prevailing assumption that the first £30,000 of all termination payments will always be exempt from income tax and NIC. Unfortunately, this is not the case. As with any payment or benefit given to an employee, the starting point should be an assumption that income tax and NIC is potentially due, and only once all relevant legislation has been considered should we reach the part of legislation which deals with termination payments, which for reference is Part 6 by TEPA 2003 in Section 401 in particular. This is actually opposite to the way in which most termination packages are considered. Once within the termination payments section of the legislation, it is still not necessarily the case that the payment is free of income tax up to £30,000. Further relief, or perhaps even full relief from income tax, may be available because of specific provisions. And I will look in more detail at some of the different types of payments shortly. As professionals wanting to ensure that termination payments are being correctly treated and reported, there are probably three key steps which should be followed. The first step is ensuring the full circumstances leading to termination are understood. So why is the employment ending? The second step is identifying each element of the package. What is the employee receiving and why? And I think at this point it's probably just worth emphasising that it is the substance of the payment which is relevant, not how it's being described in the settlement agreement or other correspondence with the employee. If HMRC conducts an employer compliance review, they will look at all associated paperwork, and they will challenge elements which appear to have been kind of renamed or reclassified. And the third step is understanding the individual's employment history. So are there particular factors during the employment which may be relevant to the income tax and NIC position on the termination? And there are two main reasons why it's so important to understand the correct income tax and NIC implications and operate withholding via pay-as-you-earn when necessary. The first is that whilst income tax relief, and that's ignoring any additional reliefs which could be available, is capped at £30,000, NIC relief is not. So if payments are genuine termination payments taxable within Section 401, NIC is not payable. So therefore, some careful consideration of the rules can effectively save you as the employer 13.8% in NIC costs. The second reason is that when mistakes are made, HMRC will seek any underpayment of PAYE and NIC and interest and penalties from the employer. And this is irrespective of any indemnity clauses which may be included within a settlement agreement. From a PY and NIC perspective, statutory enhanced redundancy payments are the most straightforward. They are always taxable under specific rules applicable to termination payments. It does not matter whether redundancy stems from a voluntary or compulsory redundancy programme. As long as for employment law purposes, the situation qualifies as a redundancy, then the income tax and NIC treatment of the payments will follow. What is important though, particularly if there are any unusual circumstances, is that any employment law advice sought which confirms that the conditions for redundancy are met are retained on file in the event of future inquiry by HMRC. Now, given the income tax and NIC advantages, HMRC are likely to challenge the true nature of enhanced redundancy payments, especially where the payments are made are being particularly generous to individuals who are near retirement age, or payments are determined on a person-by-person basis rather than a fixed formula which is applicable to all employees. And in certain situations, it may be possible to structure enhanced redundancy payments so that those employees exiting the business last, so for example, if an entire business is being closed down, that they receive a sort of a more generous level of compensation. If the arrangements are a direct inducement to achieve a particular outcome, then it's likely that the payment should be treated as terminal bonus and subject to pay-as-you-earn and NIC as earnings. Contractual payments can take a number of forms, such as salary up to the date of termination, garden leave, contractual notice periods, or accrued holiday pay, and I'll look in a bit more detail at notice periods shortly. They are all subject to income tax via pay-as-you-earn and NIC in full as earnings deriving from the employment. A terminal bonus may be agreed as part of the termination process, typically to tie an employee or groups of employees to the business. The arrangement may not form part of contractual terms, but nonetheless it is still treated as earnings from the employment. And finally, payments for restrictive covenants are subject to pay-as-you-earn and NIC under specific legislation. If new restrictive covenants are entered into, but a specific payment is not made or seems very low, then HMRC may seek to attribute some or all of other elements to the restriction, with resulting pay-as-you-earn and NIC consequences. So again, advice received by lawyers on an appropriate level of payment should be retained on file. The tax legislation contains an elephant trap in the form of the Employer Finance Retirement Benefit Scheme, or EFRBS legislation, and this captures nearly all payments or benefits on or anticipation of retirement or on death, apart from some very limited exclusions. Apart from a genuine redundancy situation, a payment or benefit made on termination of employment may be taxable as relating to a form of unapproved retirement arrangement, as this part of the legislation is broadly drawn and has priority of taxation. The consequences are income tax and possibly NIC will be due in full. So what is retirement? Well, there is no definition, but the closer in age a person is to state retirement age, the greater the risk of HMRC challenging the true source of any payment being made. Whether someone is retiring should be a matter of fact. So are they going to a new employment or actively seeking further similar employment? Or conversely, are they significantly stepping back from corporate life? However, if this information is not captured and retained on file, it can be difficult to persuade HMRC to the contrary in the event of future inquiry. When senior executives leave the business, it may not be desirable to reflect the true circumstances leading to the departure in any public communications. So if such communications imply that the individual is retiring, then documentation held on file will be critical in subsequent discussions with HMRC. About 15 years ago, there were several significant cases which explored and challenged HMRC's approach to the application of the PAY and NIC legislation to pile-on payments. Within the profession, we do not necessarily agree with the interpretation adopted by HMRC, but their approach has remained settled now for a number of years. Where a pile-on is made under a contractual right, and that is whether it's an absolute or discretionary right, the payment is subject to PAY and NIC. Where the contract simply provides that an employee is entitled to receive notice, the position is more complex. Whilst the contract may have been breached for employment law purposes, for income tax and NIC purposes, HMRC look at whether the pile-on was an automatic response to the situation or an auto-pile-on. That is, every time someone exits a business, they will receive a pile-on rather than be given notice. If HMRC consider that it is an auto-pile-on, then PAY and NIC should be operated in full. If it is not, and then assuming the payment is not otherwise taxable as an EFRB, it can be taxed as a termination payment. When contracts do not contain pylon clauses, it is critical there is a process in place which ensures that, firstly, an assessment is made regarding whether the exiting employees should work some or all of their notice period, and then secondly, that the decision-making process and the outcome is documented. And this is in order to help prevent the payment being considered by an auto-pylon on inspection by HMRC. Regardless of whether a payment is described as a pylon, to the extent that the employee has worked some or their notice period, then the payment cannot be a pylon. So, provided the payment is not otherwise taxed as an EFIRB, it should be thought to be taxed as a termination payment. So in situations where large-scale redundancies are being made, this can have a significant impact on the cost of business if employer NIC at 13.8 is being paid unnecessarily on payments which are being misdescribed. So, assuming you've safely negotiated through the legislation and you've decided that what is being paid is not earnings from the employment, a restrictive covenant, a taxable pylon or an EFIRB, then hopefully we'll arrive at Section 401 of ITEPA, the section which I mentioned, which deals with termination payments. It's not uncommon for compensatory payments simply described as ex gratia payments, although in reality what the business is paying is likely to be a compensation for lost office or employment, possibly combined with compensation for breach of contract or a pylon. A compensatory payment may be calculated with reference to a number of factors such as salary, length of service, the value of benefits provided, and possibly also a bonus payment which may have been payable had the employee remained in employment. Matthew will be looking in more detail at bonus payments for exiting employees, but from a PAY and NIC perspective, if what is being paid is simply the bonus, then PAY and NIC should be operated in the usual way. If, however, what is being paid is compensatory, but which is being calculated by reference to the bonus plan rules, and it's not intended to be as a reward for past service, then it may fall within Section 401, assuming, of course, it's not an EFIRB. The Gourley principle seeks to put employees in the same net position following receipt of damages payments as they would have been had the contract continued, and HMRC do sometimes challenge the level of settlements made. However, even if HMRC do challenge the level of damages payments, this does not necessarily change the income tax NIC treatment. But again, file records and notes evidencing any negotiations with the former employee and or their advisors is likely to be helpful in support. As mentioned at the beginning, there are circumstances when income tax relief may not be limited to £30,000. Payments made from the termination of employment caused by disablement, including injury or death, are specifically exempt from income tax NIC as termination payments. But only payments relating to death by accident are specifically excluded from being taxed in EFIRB. So therefore, a payment made to an employee who dies of natural causes is fully caught within the EFIRB's legislation. So far as death by accident is concerned, the death does not need to have been caused by the employment, just simply that the death has caused the ending of the employment. Case law has established that payments made as compensation for injury to feelings may fall outside of Section 401 if the discriminatory events happened during employment and were not directly connected with the termination of employment. So a careful examination of the facts will be required, and it may again be desirable to seek agreement from HMRC if the payments are significant. Traditionally, making employer pension contributions into the exiting employee's pension plans have been used to, or as a means of mitigating income tax NIC. Since the changes to the pension rules and the significant reductions in annual limits on tax relief for pension contributions, structuring termination packages in this way may no longer be as attractive from the employee's perspective, but it should still save NIC if it was otherwise due. The arrangements need to be implemented correctly so the employee does not inadvertently become entitled to receive cash. So timing is everything. The legislation also provides for certain benefits to be provided free of income tax and NIC, in addition to the £30,000 exemption. These include outplacement counselling and retraining, which are intended to help the exiting employee cope with the situation and provide them with knowledge and skills and access to facilities to enable them to seek further work. There are a number of criteria which must be met for these exemptions to apply, in addition to Section 401. Legal fees are also exempt from income tax NIC if they're paid directly to the advisor and if there's a requirement for the employer to pay the costs as part of reaching settlement, or if they're made in accordance with the court order. If the payment is otherwise taxed under Section 401 and the employer has spent some of their time working overseas, and broadly during that time their earnings were not chargeable to UK income tax, they may be entitled to foreign service relief. If sufficient time has been spent overseas, the payment will be exempt in full, but otherwise the charge under Section 401 is reduced on a proportionate basis. But it must be remembered that the £30,000 is applied first before any foreign service relief. And finally on that point, strictly, if partial relief is to be applied through payroll, this should be agreed with HMRC in advance. The rules I've been outlining apply to both payments and any benefits, provided that the continued provision of benefits has been agreed as part of termination arrangements. And the £30,000 exemption is applied to cash payments first, and then, to the extent it's not been used up, can reduce the taxable value of benefits provided. I've been referring periodically to the importance of paperwork and documentation, and it's critical to ensure that the tax and NIC implications of arrangements are understood, a document is appropriate, and for example this could be in a settlement agreement, and then the income tax, NIC and reporting requirements are actually met in practice. Any cash payments should be paid via payroll, and even tax-free amounts should be included in associated RTI reports to HMRC. If a combination of cash and benefits are provided, which together are valued at more than £30,000, then a separate termination report should be made to HMRC by the 6th July following the tax year end. There is no statutory format, but benefits provided in these circumstances do not also need to be included on Form P11D. And again, for the purpose of termination benefits, the value of the benefits is estimated at the time of termination, and unless there is a significant change in value, then there is no further requirement to provide updated information to HMRC. The timing of cash payments and whether they're paid before or after the P45 has been issued will determine the way PAYE and NIC, if it's due, will be applied. Sometimes the arrangements agreed on termination will set out that payments be made in tranches, potentially across one or more tax years. Provided the timing of payments is agreed during the negotiations, then this may be effective, but it should be remembered that additional criteria regarding the time that pay-as-you-earn should be operated apply to directors. And finally, for redundancy situations, it should be possible to request HMRC clearance on the proposed income tax NIC treatment, so for example, for enhanced redundancy payments and benefits. And in the past, HMRC have usually responded to such requests quite quickly. However, recently we have become aware that there have been occasions when HMRC have been reluctant to provide clearance in advance of payments being made. Now, I've covered a lot during the last 15 minutes or so, but if you remember nothing else, here are 6 key points to take away. So on that note, I will now hand over to David.
Thank you, Claire, and good afternoon, everybody. Thank you for joining us. I'm David Ogden. I'm a director on the reward team, and I'm going to talk about the tax treatment of shares and options held by leavers. And I'm going to start with the tax-favoured share plans. These are ShareSave, SIPs, company share options, EMI, and employee shareholder shares. And then the second part of my presentation will be about the non-qualifying plans. Let's start with ShareSave. ShareSave, or savings-related share options, or SAYE plans, are really simple. First of all, we have a list of acceptable good leaver provisions, and if you leave for any other reason, then your option would generally lapse, so there really is no income tax. And if you exercise your option within 6 months of leaving due to injury, disability, redundancy, retirement, or the sale of your employing company or business, then there's no income tax, and if you leave for another reason, you would expect your option to lapse. So we can move straight on to share incentive plans. Now, a SIP leaver must take his or her shares out of the plan when they leave, regardless of whether they're a good leaver or a bad leaver. That's a good thing, because it means that the shares come out and the administrators don't have to worry about shares being left in the plan and losing track of former employees. And then if the individual is a good leaver, leaving for similar reasons to ShareSave, injury, disability, redundancy, retirement, or disposal of their employing company or business, then there is no income tax. The shares can simply be transferred to the employee, or the employee can ask for them to be sold. But if somebody leaves voluntarily, then there will be income tax when the shares are removed, and the amount that's subject to income tax will depend on the length of time that the shares have been in the plan. So if the shares have been in the SIP for less than 3 years, then there'll be income tax and national insurance on the market value of the shares at the date of leaving. Whereas if the shares have been in the SIP between 3 and 5 years, then there'll be income tax and national insurance on the lower of the initial value of the shares and the market value at the date of leaving. Of course, if they've been in the plan for more than 5 years, there won't be any income tax. What you might find, though, is that if you're buying shares monthly, particularly with partnership shares or with matching shares, and you have monthly allocations of shares, these 3 and 5 year periods are rolling periods, and so it's quite likely that people will have some shares that are less than 3 years old, some between 3 and 5 years old, and if they've been there long enough, some shares that are more than 5 years old. You also, of course, have to take care about whether or not there are any forfeiture provisions, because sometimes employees will lose their free or matching shares if they've held them in the plan for less than 3 years. If you do have to remove shares from the plan and there is income tax payable, then the default is generally that sufficient shares can be sold unless the employee makes a payment in respect of the tax before the shares come out of the plan. Now, that's all reasonably straightforward. The slightly awkward bit is that if there's any residual partnership share money, then that also has to be refunded to the company and paid out subject to income tax and NIC. And that's the case whether the employee is a good leaver or a so-called bad leaver. CSOPs, company share option plans, are interesting because they can either include good leaver provisions or the rules can say that any leaver is a bad leaver and their options will lapse. Let's assume that you have the good leaver provisions in your plan. Then there'll be no income tax if the option is exercised within 6 months of leaving due to injury, disability, redundancy, retirement, or if they're leaving because of the sale of their employing company or employing business. There might also be the discretion for the directors to allow early exercise for people who leave for another reason. And there's no income tax if you leave due to one of the good leaver reasons, but if the directors exercise their discretion, then if you exercise the option less than 3 years after the date of grant, then there'll be income tax, and again that's likely to be subject to PAYE. EMI, enterprise management incentives, were introduced much later than share save and CSOPs, and so the rules are quite different to the other share option plans. There are no good leaver provisions in the legislation. Whether a leaver can exercise his option or not depends on what the company puts in the plan rules, or sometimes the plan rules will allow the directors complete discretion. Let's assume that the leaver can exercise his or her option, and if the option exercise price was equal to the market value of a share at the date of grant, then there'll be no income tax if the option is exercised within 90 days of leaving. If the option was granted at a discount, then regardless of when you exercise, there will be income tax on the difference between the exercise price and the lower of the market value at the date of grant and the market value at the date of leaving. If a leaver exercises his option more than 90 days after leaving, there could be a further income tax liability. Cessation of employment is a disqualifying event for tax relief purposes, which means that it disqualifies any future tax relief. And occasionally, a participant might be allowed to keep their options after they've left, and then if they don't exercise that option for a considerable period of time, it's possible for the share price to go up, and then the difference between the market value of the shares at the date of leaving and the market value at the date of exercise will be subject to income tax. I had an example a couple of years ago where someone had been granted an option when the market value and the exercise price was 50 pence. they left shortly afterwards when the market value was 60 pence, and they were allowed to hold on to their options. But then a couple of years later, the company was taken over, and all the shares had to be sold, and the price at the date of sale was £4. In that case, the difference between 50 and 60 pence was a capital gain, but the difference between 60 pence and £4 was subject to income tax because the option was exercised more than 90 days after the disqualifying event. If you're an employee shareholder and you leave, then there shouldn't be any income tax when you do leave. The income tax point for employee shareholder shares is generally the date on which they're awarded. So you get between £2,000 and £50,000 worth of shares, and the excess over £2,000 worth is subject to income tax when you receive the shares. Now, when we put in an employee shareholder plan, we generally expect the individual to elect to ignore any restrictions on the shares on the date of grant and sign an election to that effect, so that there shouldn't be any income tax on leaving. And then, of course, if the shares are sold, either on leaving or at a later date, whether the individual's left or not, there shouldn't be any capital gains tax payable either. You'll also find in private companies that rather than allowing the individual to hold on to their employee shareholder shares, if there is no market, the company will buy the shares back. Now, in this case, there'll be no income tax, even though normally you would expect a repurchase of shares by the company to be treated as a distribution or a dividend and subject to income tax. Moving on to the non-qualifying plans. I want to deal with unapproved options, LTIPs or performance share plans, restricted shares, that's shares which are subject to a risk of forfeiture, and shares acquired for less than market value, by which I'm actually referring to nil or partly paid shares. The taxation of unapproved options, and I hope you don't mind if I still call them unapproved. I know they're non-qualifying and there's no such thing as approved anymore, but to be honest, after all this time, I'm just so used to saying unapproved, I'd be tying myself in knots trying to go for non-qualifying all the way through. So, once I've got the terminology right, the taxation is really quite simple. Income tax and national insurance is due on the exercise of an unapproved option, whether the employee sells the shares or not. And the income tax is due on the difference between the exercise price and the market value of the shares at the date of exercise. If the shares are readily convertible assets, or RCAs, then the income tax must be handed over to HMRC via the PAYE system, and the benefits also subject to employers' and employees' national insurance. Readily convertible assets means that the shares can be converted readily or easily into cash. So if you've got listed company shares or AIM shares, they're readily convertible because you can convert them into cash by selling them on the stock market. You might also find that shares in a private company are RCAs if there's some sort of facility whereby the employee can sell his shares. This can be a general facility or some internal marketplace, or it might just be a specific arrangement so that leavers can sell their shares either to the company or possibly to an employee benefit trust. If you've got shares in a subsidiary, then they're automatically deemed to be RCAs. If the shares are not readily convertible assets, then there will still be income tax, but that will be payable by self-assessment, and there's no national insurance due. Now, I did say that the income tax is due on the market value of the shares. If the shares are sold on the date of exercise, HMRC will generally accept that the sale price is the market value of the shares, but that's the actual price of the share that you're selling at, not the net price after dealing charges. So you don't get any credit against your income tax for dealing charges. Of course, if a person's already left when they exercise their option, you will expect them to have received their P45, and therefore the income tax must still be collected through the PAYE system, but it's done using a 0T tax code. This is done as though it were just 1 month or one pay period, and everything else is ignored, including the personal allowance. So on this slide, I show you how much of the market value is subject to income tax at 20% or 40% or 45%. And it is possible, particularly for a basic rate or even a 40% taxpayer, to end up paying more tax than they should, or having more tax handed over to HMRC than they should. And if that is the case, then you have to correct any under or overpayment on your self-assessment tax return. Now, I did say that the company has an obligation to hand over the income tax to HMRC via the PAYE system if the shares are readily convertible assets. But of course, the employee then has to make good the income tax to his employer or former employer. The rules have now changed on that, but the employee must still make good the income tax, but rather than it having to be done within 90 days of exercise, as previously was the case, you now have to collect the income tax from the employee within 90 days after the end of the tax year. That's really helpful because sometimes a company might forget to collect the income tax or not have a provision, or sometimes if it's an overseas company, the UK company doesn't even know that the individual has exercised. And it's only when you're filling in Form 42 or the online equivalent that you realise that the income tax wasn't collected, and you really have to pull your finger out quickly and get that money back off the employee. If the employee doesn't make good the income tax by the deadline, then the tax not made good is treated as a benefit in kind, and the individual has to pay income tax and national insurance via self-assessment on the benefit. So let's say you had £1,000 worth of shares and you're a 40% taxpayer, then your tax bill via PAYE should be £400. If you don't make that good to the company, then the £400 is treated as a benefit in kind, and you have to pay income tax on that. So 40% of £400 is another £160. And if the company can still enforce the payment of income tax, you have to make it good, and you have to pay the benefit in kind charge, and you could end up having paid £560 in income tax, plus you have to pay national insurance on that benefit. Now, most long-term incentive plans are structured either as nil-cost options or, less frequently these days, as conditional awards of shares that vest at the end of a certain period of time. And the income tax will be due in much the same way as it is for an unapproved option, either on the exercise of the nil-cost option or when the vested performance shares or conditional award of shares, when the shares are transferred to the employee. An alternative way of structuring an LTIP, though, is with restricted shares. This is where you get the shares up front, and then if you leave or if the performance conditions aren't met, then you forfeit the shares. When the individual gets the shares, he may jointly elect with his employer to ignore the restrictions for tax purposes and pay the income tax up front on the difference between the price that he pays, if there is any, and the market value of the shares at the date of award. Now, if you expect the value of the shares to rise exponentially and you expect to stay with the company, it could be attractive to pay the income tax up front, because particularly in a private company, the initial market value might be so low that, first of all, you can afford to pay the tax, and when the shares are released or no longer subject to forfeiture at the other end, the whole growth in value should be subject to capital gains tax. And they might even be you might even qualify for entrepreneurs' relief on growth in value. Now, it's all very well and good making an election and paying the income tax up front on your restricted shares, but if you do that and you leave and you forfeit the shares, then you don't get the income tax back. If you haven't made an election and you forfeit the shares, then obviously there's no income tax. But if you're allowed to keep the shares and you haven't made an election, the income tax will be calculated on the market value of the shares at the date of vesting, which is usually the date of leaving. And then finally, in my section, I just want to spend a minute talking about partly paid shares or nil paid shares. When payment has been deferred, then you may get some shares, but you're not expected to pay for them until just before you sell the shares. Then, of course, if you do leave, you will generally have to pay the shares up at that time. Now, if you leave, then if you have nil paid shares, the amount outstanding is treated as a notional loan, and when you dispose of the shares, technically the subscription price must be paid before you sell the shares. Otherwise, the notional loan is treated as having been written off, and that will trigger an income tax liability. Now, in practice, HMRC will accept that if the shares are sold and the subscription price is paid out of the sale proceeds as part of a single transaction, then no income tax liability will arise. It is a bit circular, but you really must do it. You must sell the shares and pay up the subscription price. You can't net off the subscription price because that will be treated as the loan having been written off. Now, I'm going to hand over to Matthew, but if you have any questions, then do type them into the box, and we're hoping to have a little bit of time for that later. Or contact us later. You will have our contact details at the end. So thank you very much for listening. Nice to see that almost everybody's still there, and here's Matthew.
Okay, thanks, David. So we've looked at how cash payments and share-based awards are treated and taxed on termination. So now I want to go on to consider how subsisting bonuses are treated on termination, and then do a quick recap on the latest position in relation to the exercise of discretions. So what does the employment contract and the cash bonus plan rule say? Well, usually employment contracts provide very bland language about entitlement to a bonus, along the lines of the employee may be entitled to receive a bonus payment pursuant to the company's annual bonus plan as amended from time to time, and that any payments made under the annual bonus plan are entirely at the discretion of the board. And the intention of using such bland and minimal language within the contract is to avoid any contractual entitlement arising. Whether the bonus is discretionary or contractual will be a key issue on termination. So in relation to discretions, just a quick recap on the latest position in relation to the exercise of discretions and bonus plans. In Clark versus Nomura, it was held that discretion must be exercised in, or must not be exercised in a rational or perverse manner. For example, where an employer exercises its discretion by choosing not to award a bonus, even if the employee has hit predetermined bonus targets. And you should also bear in mind that discretionary bonus, which has been paid out every year over a considerable period of time, may be viewed as an implied contractual entitlement through custom and practice. In Commerce Bank and Keene, the Court of Appeal ruled that where an employee argues that the employer's exercise of discretion was irrational, it's for the employee to establish a rationality, and that is that the employer acted in a way in which no other reasonable employer would have done before the employer is required to justify its decision. Therefore, the burden of proof based on a rationality is now more onerous for the employee. So what is clear is that employers who do not put in place clear bonus plans or who apply the criteria established by those plans in an ambiguous manner leave themselves open to claims by their employees. Although the decision in Commerce Bank has placed the onus of establishing a rationality on the employees, the employer should nevertheless have clear and justifiable reasons in mind when exercising their discretion, particularly on termination where the employee is much more likely to challenge any non-payment of a bonus. So next we'll consider what the discretion actually relates to. It's common to see bonus plans which state that a bonus is at the discretion of the employer, but which are then silent as to what the discretion relates. For example, would the discretion be applied to the amount of the individual bonus, the proportion of the bonus pool to which an employee is entitled, the criteria against which entitlement is determined, or some other matter? Whilst not specifying these details may seemingly give the employer the freedom to determine the amount of the bonus each year, the reality is that it can make it more difficult for an employer to justify their decision as being rational. Therefore, an employer may like to consider the extent to which the bonus will be determined by reference to company performance and or individual performance, even if the exact criteria and their weighting remain discretionary. This would reduce the chance of the exercise of the employer's discretion being challenged as irrational. So, what should go into the bonus plan rules? Well, as regards leavers, the bonus rule should ideally be clear on what happens if an employee leaves partway through a bonus year. Generally, a bonus will only be payable if the employee remains in employment and not under notice on the relevant payment date. However, it's not uncommon for bonus plan rules to allow good leavers to receive a prorated bonus. Claire has already discussed how any cash payments are likely to be taxed, but it's important to note that the plan rule should include and stipulate that any payments made pursuant to the plan rules are subject to deductions for tax and NIC, and it's surprising actually how many plans have no or defective withholding provisions. So turning to the Blue Bay asset management case, which was more commonly known as the £1.7 million lunch in the newspapers at the time. The High Court here confirmed that companies operating employee incentive plans should be able to link the exercise of a discretion to treat departing employees as a good leaver to a condition that the employee has not breached their employment contract or post-termination restrictive covenants. This case involved a trader who participated in the company's deferred bonus plan who left Blue Bay under a settlement agreement. It was agreed that he would be treated as a good leaver provided he complied with the terms of the settlement agreement. It subsequently came to light that he'd acted in breach of the terms of the settlement agreement by taking a former colleague to lunch with a view to soliciting his services for a new enterprise that he was about to commence. Blue Bay lapsed his deferred bonus, which resulted in him losing his entitlement to the £1.7 million bonus. He brought a claim on two grounds. First, he argued that he had not acted in breach of contract, and further, that if he was in breach, the condition in the settlement agreement which resulted in his deferred bonus lapsing in consequence of his breach was an unlawful penalty, because the object of the clause was not to legitimately compensate Blue Bay for the loss it had incurred. The court rejected both arguments. It held that the clause was not a clause that required the employee to transfer cash or property on breaching the contract, which could potentially be a penalty clause, but instead merely imposed, as a matter of contract, a condition that had to be met before the employee would be treated as a good leaver. As the condition was not met, the employee was not treated as a good leaver, resulting in the award lapsing. Current best practice for share plan leaver provisions, particularly where the plan is subject to performance conditions, is that good leavers should not receive an early vesting, but instead should only receive vesting on the normal vesting date, at the same time as non-leavers when the performance conditions will have been tested. That way there will be a period between the leaving date and the vesting date, increasing the chances that the employer may have discovered misconduct before the award vests, which would allow the company to lapse the award or operate a malus adjustment, which I'll go on to discuss in a moment. The Blue Bay case gives comfort that companies can agree to treat an employee as a good leaver, subject to set conditions being satisfied. So next we have a quick recap as to what clawback and malus adjustments are and how they operate and why they may be applied on termination. The term clawback is used to describe a variety of mechanisms aimed at preventing employees benefiting in what later turns out to be unjustified circumstances. Clawback provisions generally fall into two categories. We have soft clawback, or malus adjustment, which refers to provisions that allow for a negative adjustment to be made to outstanding awards, including by way of forfeiture, where the employer sets off the excess value that's already been paid or released against future vestings held by the employee, whether under the same or a different plan. And when we talk about hard clawback, here we refer to provisions that require the employee to return shares or cash that's already been paid to them. And to the extent that set off against future vesting isn't possible, it entails a contractual obligation on the employee to transfer shares back to the company or to repay the excess value. I mean, the hard clawback really is generally seen as a mechanism of last resort, albeit an important one, but should be not considered in isolation. Clawback, therefore, forms part of the plan design, but should not be seen as the only mechanism to address risk. Hard clawback always needs to be approached with care to reduce the risk of being deemed to be an unlawful penalty clause and also to manage any tax issues. By way of recap, the key regulatory provisions in this area, for those companies that are subject to the new September 2014 UK Corporate Governance Code, it states that schemes should include provisions that would enable the company to recover sums paid or withhold the payment of any sum and specify the circumstances in which it's appropriate to do so. The FRC decided against specifying any of the circumstances in which clawback arrangements might apply, as they were of the view that best practice is still evolving and they didn't wish to constrain how this develops. And this really ties in with Regulation 26E of the new reporting regulations, which require companies to provide an explanation as to whether any provisions for the recovery of sums paid or the withholding of payments of any sums in their remuneration policy. The IMA rules, formerly the ABI rules, state that structures should include provisions that allow the company in specified circumstances to forfeit all or part of the bonus or long-term incentive before it's vested or recover sums that have already been paid. Then, again, we're talking about soft or hard clawback. And for financial services firms, the FCA has already introduced remuneration codes for some of the financial services firms, which require them to operate risk adjustment in respect of deferred portions of variable remuneration. So next, the question to consider is, why would clawback be relevant on termination? Well, clawback may be required if the employee is, for example, sacked for gross misconduct, and had the company been aware of the act or omission which justified the summary dismissal, the payment would never have been made. The key question is whether the plan rules provide for clawback, and if it does, whether it should be on a net, i.e. post-tax, or a gross pre-tax basis. The tax position on operating hard clawback can be quite complex. Operating malus adjustment, or soft clawback, is relatively simple and straightforward, and generally has no adverse tax consequences for either party. However, where hard clawback is applied, the position is not so straightforward, especially if it's operated on a gross basis. The 2014 case of HMRC versus Martin, the Appellate Tribunal upheld the first-tier tribunal's decision in 2013 that a payment from an employee to his employer would fall within the category of negative taxable earnings if the payment had attributes of positive taxable earnings. Very broadly, what this means is that if the payment would be considered taxable earnings when it was paid, its repayment would be considered negative taxable earnings. If this results in a negative figure for taxable earnings, relief may now be available in circumstances where previously no relief was. The Upper Tribunal did emphasise that the decision was based on the particular contractual terms in issue, and a different set of facts could have produced a different conclusion. Therefore, if companies are considering operating clawback on a gross basis, they need to be careful to review the clawback provisions to determine whether tax relief may be available for the employees if it was operated. In addition, there will be practical issues in operating clawback on a gross basis because there will be a time delay before the tax relief is available, during which the employee will be out of pocket. This arises because the employee would need to claim for the amount of the clawback through their self-assessment tax return, while having to repay the clawback amount up front. So we've looked at how clawback works and the tax issues associated with it. So now we turn to the sort of very topical and controversial issue of actually enforcing a clawback provision. And seeking to enforce hard clawback as a debt owed to the company is likely to be more difficult, as it means suing the employee, which is often unpleasant for all parties and can cause wider HR issues. However, generally, remuneration committees retain discretion as to whether or not they wish to apply clawback. In the Tesco case, Tesco paid more than £2 million to its former chief executive and finance director after being told it had no legal grounds to continue withholding the payments. The supermarket chain had announced in October that it was blocking payments of £1.2 million to Philip Clark and £970,000 to Laurie McQueen, while it investigated last year's £263 million accounting scandal, which came to light after the pair left. However, Tesco eventually paid out the bonuses under legal challenge, and therefore questioned whether the clawback provisions were sufficiently robust and covered the specific circumstances. Finally, I just want to remind ourselves of the well-known case, that of Tesco versus Pook, so it's Tesco again, and the implications for companies operating cash and share-based plans. Mr. Pook was a senior manager of Tesco who stole from Tesco by approving fraudulent payments to his own company, for which he was imprisoned, and he solicited a bribe from firms supplying services to Tesco to ensure that the firm continued to receive the work. Tesco sued, and Mr. Pook counterclaimed to enforce exercise of a share option, which he had attempted to exercise while he was suspended pending disciplinary proceedings, which ended in his dismissal. The High Court held that the option exercise would not be enforced on two grounds. First, Mr. Pook had fiduciary duties towards Tesco and was therefore under obligation to report his own very serious misconduct to his employer, who would then have immediately dismissed him, therefore lapsing the option. And secondly, to allow Mr. Pook to enforce his option exercise would let him profit from his breach of this fiduciary duty. Therefore, the court found that there was an implied term in the option that it couldn't be exercised while he was guilty of a reprudatory breach. Therefore, there's nothing in the judgment that suggests this implied term, which the court found, is restricted to option holders having fiduciary duties towards their employers. I mean, the case does show that where the plan rules do not contain clawback provisions, the court may be prepared to step in and read into the contract an implied term to prevent an employee benefiting in circumstances where the employee is guilty of a reprudatory breach of contract. And so finally, just on my last slide, this considers the position for those companies that have binding remuneration policies and the implications they have for companies making payments to directors. Again, as a quick recap, an approved policy sets out the company's forward-looking policy on remuneration and potential payments, including the approach to termination payments, and is subject to a binding shareholder vote at least every 3 years. Within this forward-looking approved policy, companies are required to have a specific policy on payments to directors for loss of office. Companies will need to consider their policy on loss of office payments to see if it's sufficiently flexible to cover the specific circumstances, as payments falling outside of the policy can't be made unless they are specifically approved by shareholders. On termination, the Remuneration Committee will need to consider what the loss of office policy is, and amongst other things in respect of the Remuneration Committee's ability to classify leavers, and how the Remuneration Committee assesses salary, short-term incentives, long-term incentives, pensions and other benefits. One of the more controversial changes to the Companies Act 2006 was the requirement for the applicable companies to publish a statement on their website as soon as reasonably practical when a director leaves, giving details of any loss of office payments and remuneration payments which have been made or will be made to the departing director, and an explanation of how these payments were calculated. It should be noted that the Companies Act doesn't distinguish between executive and non-executive directors, and that companies will therefore be required to make similar statements regarding departing non-executive directors, even though the payments of the final monthly fee may all be that need to be disclosed. Companies must make the statements available as soon as reasonably practical, so when or very soon after the arrangements have been confirmed. The GC 100 guidance indicates this should usually be on the date that the departure is announced to the market. Where companies need further time to prepare and agree the exact wording between announcement and departure from the board, companies may wish to consider giving a commitment to announce any payments as soon as the arrangements become known. If a payment is made to a director which is not consistent with the approved policy, generally any obligation to make that payment will be unenforceable, and any non-compliant payments actually made will be held by the director on trust for the company. And the directors who authorise the non-compliant payment will be jointly and severally liable to indemnify the company for any resulting loss. However, the courts may relieve the director from liability if the director can show that he acted reasonably and honestly. And as I'm sure you're aware, these provisions don't apply to payments which were required to be made under an agreement entered into pre-27 June 2012, which hasn't been modified. But I think a lot of those now have been brought into line. So I think we've covered most of the key tax and practical issues that tend to arise when exiting an employee, but I know we have received a couple of web-based questions which we'll endeavour to answer. I'll pick up this first one, actually, I'm just looking at now, and it's a question as something that David mentioned about employee shareholder status, and it says, David briefly mentioned the tax position if the employee or director that is being terminated is holding employee shareholder status shares. Does this involve any additional complications for the company, and are companies still continuing to incentivise employees via ESS? So, by way of a very quick recap for those of you not familiar with employee shareholder status, it allows employees to subscribe for a minimum of £2,000 worth of shares in their employer or parent company at no cost in return for giving up some statutory employment law rights. And David mentioned the tax treatment when he went through that. So, to answer your question, there are no additional complications of dealing with leavers that hold ESS shares as opposed to any other type of shares. And to answer the second part of your question, a huge number of companies have established ESS arrangements, and we continue to be very busy, actually, implementing what is an extremely tax-efficient way of incentivise companies' employees. And for those of you who are interested, when I circulate the slides, I can attach a flyer on ESS showing how it works and the sort of very generous benefits that it offers. So have we got any other questions?
Yep, I've got a couple. Well, quite a few have come in. There's a couple that are reasonably similar, so I thought I'd sort of try and link them together and answer them in one go. So there's some questions have come in about discretionary RSUs and bonuses, and if they're forfeited on termination, can they be under 401? And a similar question about items if they're rebadged. You know, what does that mean? And will HMRC challenge them whether they're in Section 401? So relating to bonuses and the like. So I suppose coming back to the points we were talking about earlier, if things are genuinely discretionary and actually there is no entitlement to receive them, then in principle what is being paid on termination is not the bonus, it is actually some other compensatory amount. So what's happening is not being rebadged, because clearly, you know, as the question's rightly said, HMRC will challenge things which appear to have just been renamed and called something else. But if it genuinely isn't a bonus, it's actually something else, it's just a formula for perhaps calculating compensatory payment, then potentially, yes, it can fall within Section 401. Subject to all the bits I was talking about earlier about employer finance, retirement benefit schemes and so on.
Okay. Right, well, if anyone has any additional questions that we haven't managed to answer during the session, our contact details are set out on the last but one slide, and we'd be very happy to discuss these with you. But all that's left for me to do is to thank you for attending our webinar and wish you all a very pleasant afternoon. Thank you very much.